All right.
Hello, everybody. I'm David Turk. I'm the president of the Beacon Hill Institute, and happy to introduce this third in our series of webinars that we've been conducting over the weeks on economic issues. Our guest of honor today is Scott Sumner, and he's the Ralph Hawtrey Chair of Monetary Policy at the Mercatus Center at George Mason University. He is also Professor Emeritus at Bentley University and Research Fellow of the Independence Institute. And he has spent his career specializing in monetary matters. Shortly after I'm done here, Frank Conte, our Director of External Relations, will start asking Scott some questions about his latest book, Money Illusion. And Frank and Scott will be talking back and forth over the course of the hour. About 15 minutes until 1 or so, I will ask Will Burke, who I would like to introduce now, to read any questions that are posted on the chat link in Zoom to Scott, who will then provide answers. And Will Burke is our Director of Research, and Frank, as I said, our Director of External Relations. So I'm going to turn it over to you first, Will, to provide some detailed information, and then Frank, you'll pick it up from there.
Thank you.
Okay, guys. So coming at the conclusion of the meeting, I'll read off any questions that you have. If you could just insert them in the chat box, I'd be happy to read them. And feel free to insert any questions as we go along here. Thank you, guys.
Okay, Frank, it's all yours.
Okay, welcome, Scott Sumner. I'm glad, we really appreciate your time on this topic of market monetarism. I read the book and I'm halfway through my second read, and I find it to be a very compelling case for the macroeconomic school of market monetarism. And it's so richly detailed, but there's many things that strike me about this book. But before I ask my set of questions, I just like to ask you, what motivated you to write a book and really, at some level, take on the establishment in macroeconomic thinking today?
Well, first of all, thank you for inviting me today. I'm glad to be here. I guess the motivation was that as the Great Recession developed around 2008, it seemed to me that people were missing the point or misdiagnosing what was going wrong with the US economy. And from my perspective, it looked like the Federal Reserve was making serious policy mistakes. So I became frustrated with that. I got into blogging and did quite a bit of blogging on my views of the Great Recession. And over time, people recommended I write that up in a book. So my views were all in one place, if you will. And sometimes this perspective is called market monetarism, not just my views, but others like David Beckworth were also blogging on this topic. So I wanted to get all of these views in one place where it'd be kind of a coherent message on our view of what happened, what went wrong in the Great Recession.
So let me start out by asking if you could explain the current monetary stance, as it were, and what is essentially wrong with it with regard to how we handled the Great Recession. Let me add that I know that a lot of this book was written prior to the pandemic, but let's focus on what is it that most economists got wrong about the Great Recession?
Okay, so I think that the main problem in 2008 and 9 was that monetary policy was too contractionary. And I think the reason economists got it wrong is it didn't look particularly contractionary because interest rates had been cut. Eventually they got around to doing QE, and those look like expansionary policies. But if you look closely, the reductions in interest rates were too little too late. The so-called equilibrium interest rate in the economy, that's the rate where you'll have stability in the economy, macroeconomic stability. That equilibrium rate was falling very fast when the housing crash occurred, and the Fed didn't cut its policy rate fast enough. So as a result, aggregate demand fell very, very sharply. And then the second mistake was they didn't commit to get the economy back to the previous trend line. whether it be targeting inflation or targeting nominal GDP growth, which is what I favor. It's important that when there is a mistake and you drop below or rise above, you go back to the previous trend line with your policy stance. And I emphasize that point because I think the second time around in the COVID crisis, they did sort of learn a lesson and try to get the economy back to the previous trend line. In fact, you can argue they overshot this time around. So ironically, in this COVID recession, we have almost the opposite problem we had during the Great Recession recovery period. During the Great Recession, recovery was agonizingly slow. Unemployment stayed very, very high for many years. It was hard to get a job. Inflation was well under the Fed's target of 2%. Now we're seeing a tight labor market, rising inflation, all signs of very strong aggregate demand. So I look at this through the framework of the Fed basically determines the total amount of nominal spending in the economy through its monetary policy, and it needs to have that grow at a slow but steady rate to have sufficient, spending for full employment, but not too much for high inflation.
Okay, I have a set of questions. I might ask them out of the order that I wrote them down on my notebook here. But what was, in pointing out several alternative explanations of the Great Recession, you pointed out that conservative economists, normally called conservative economists, worried about inflation, and they were way off base. Why?
They were off base because the basic indicators they were looking at, especially QE, were not really as meaningful during a period of near zero interest rates. So normally, like if you go back before the Great Recession, when the Fed pumps money in the economy, it tends to increase inflation. And that's because money's kind of like a hot potato. People don't want to hold a lot of this newly created Fed money. And as a result, they spend it, that pushes up prices. But when interest rates fell to zero, the money being injected in the economy was basically just held by banks as bank reserves. It wasn't being pushed out into the economy. It wasn't stimulating additional spending to any great extent. Now, just to be clear, I do think that the QE programs had some effect in terms of boosting spending at the margin. But I think a lot of conservative economists overestimated how much inflation was going to result from the QE because the numbers look so large. The increase in money created by the Fed, which is called the monetary base, just to be clear, that's the cash in your wallet and also bank reserves. That monetary base was increased very dramatically by the Fed. And during earlier periods of American history, that probably would have led to very high inflation. But because of the zero interest rate environment, people just sat on that money. It was as good as investing in a treasury bill, and it didn't have the inflationary effect that a lot of people anticipated.
I noticed that you're obviously influenced by Milton Friedman, and you really go into great detail about how he came to the conclusion of what went on during the Great Depression, which was essentially tight money. And we often heard during that period that Bernanke was a great student of Milton Friedman. Do you find that to be the case? Or do you find that Bernanke didn't really understand or follow Friedman thoroughly?
Well, I think Bernanke is aware of Friedman's work and agrees with much of it. At one point, before he became Fed chair, Bernanke famously said that he agreed with Friedman that the Fed had largely caused the Great Depression, or at least made it a lot worse with a misguided monetary policy. I do disagree a little bit with Bernanke on the role of the banking crisis. I see that in the Great Depression and also in the recent Great Recession as being more endogenous. That the word endogenous means caused by other factors. So the standard view, both in the Great Recession and the Depression, was this banking crisis caused the deep downturn in the economy. But you can also reverse the causation. To some extent, the banking crisis was caused by the weak economy, by the slumping economy. And so Bernanke, when he became Fed chair, initially tried to treat the problem by sort of rescuing the banking system, not realizing that the banking system was going down because the economy was slumping so badly. So what he really needed to focus on was a more expansionary monetary policy rather than so-called bank bailouts. Now, eventually Bernanke realized there was this broader slump in the economy and changed course. But by that time, it was a little bit too late. We were already pretty deep into the Great Recession, 2008-9, that period. So I think Bernanke certainly learned some of the lessons from the work of Milton Friedman and others, but I do think he put too much weight on the banking crisis being a causal factor, not as being more of a symptom of broader failures in monetary policy.
One key point in your book that struck me as going against the grain of economic thinking was that you attacked the fallacy that low interest rates do not imply easy money. You claim, as you just did, that the Fed was too tight just before the Great Recession took hold. Most economists knew of this relationship, but why didn't they act on it? Tight money, low interest rates do not imply easy money. And most people believe that, well, when you look at, well, the Fed's pumping so much money into the economy, even today, it's low interest rates, and we're going to expect inflation. So why did most economists kind of ignore this kind of economic truth?
That's the thing that's always puzzled me, because certainly I got a lot of these ideas from Milton Friedman. He talked about how interest rates were misleading indicators in the Great Depression. And his analysis has been broadly accepted by the profession, as you indicate. I mean, economists know that a high interest rate doesn't necessarily mean tight money. It could be just inflation is high and vice versa. So during late 2008, I think there was too much complacency among economists, and I don't really fully understand why so many economists assumed that the stance of monetary policy was expansionary. Now, it may be they misjudged where the equilibrium interest rate is. So a lot of modern macro analysts kind of look at things this way. If the Fed sets the interest rate above the true equilibrium value, that's tight money. If they set the interest rate below the equilibrium value, that's easy money. Okay. So there's some truth to the fact that interest rates do influence the stance of monetary policy, but you need to compare it to the equilibrium rate, which is something we don't directly observe. We have to estimate it. And I think what happened is the equilibrium interest rate fell very sharply during the housing slump, more sharply than economists thought. So even though the Fed was gradually reducing interest rates and economists were sort of lulled into thinking those gradual cuts were expansionary, they were actually cutting their policy rate more slowly than the equilibrium rate was falling. So policy effectively became more contractionary. So even, let's take some numbers. In the middle of 2008, the rate was set at 2%, say around the time Lehman failed. That seems like a low interest rate, and historically in America it is, but probably the equilibrium rate had already fallen to 0 or even below 0 perhaps. So by setting the interest rate at 2%, they actually set it too high, and it was leading to a effectively tight money policy. Now, how do I judge tight money? I look at growth in nominal GDP. If it's growing too fast, then money's too easy. If it's growing too slow or falling, then money's effectively contractionary in my view.
That leads to my next question, NGDP targeting. Why is NGDP a better indicator, a target than interest rates? And please, before you get into that, please explain with the current, what the Fed's trying to do, what indicators they use, and then explain the ones that you would use, including, of course, NGDP.
Right. So right now they have sort of a two-stage process where they target interest rates in the short run and inflation over the longer period of time. So the term target is ambiguous. You can have a target that you're like controlling day by day, like interest rates, and another target, which is more like a goal say, 2% inflation over the long run. That's their goal.
Mhm.
With nominal GDP, I would sort of like to replace both of those. So stable long-run nominal GDP would be the goal of policy, replacing inflation targeting. And as an indicator of the stance of policy, rather than look at short-term interest rates, I would look at market forecasts of nominal GDP growth. So interest rates, because they are kind of an unreliable indicator, they can reflect many different factors, don't always tell us whether money is easy or tight. And the best way of looking at it is to look at market forecasts of where nominal GDP is likely to go over the next few years. And you want to make sure your policy stance is set at a position where the market believes nominal GDP growth will be appropriate. And long-term, that's about 4% a year, by the way, for nominal GDP, which would be roughly 2% inflation and 2% real growth.
Later on, I'd like to explore your ideas about turning to the market for the signals for targeting NGDP. But before I go there, I'd like to ask you, how is your theory different than conventional monetarism?
Okay, good question. So we agree with monetarists on a bunch of points, like that you can't, the Phillips curve trade-off doesn't work in the long run. Interest rates are not a reliable indicator of the stance of monetary policy. The monetarists also believe that, unlike the Keynesians, monetarists tend to believe the economy is inherently relatively stable and that a lot of business cycles are caused by bad monetary policy, right? Keynesians tend to see the economy as inherently unstable. So for Keynesians, the Fed is like a fireman that comes in and fixes the problem. To a monetarist, the Fed is sometimes an arsonist who creates the fire. Unknowingly, I shouldn't use the term arsonist, maybe a clumsy person with matches, let's say.
Okay.
And so we see the role of monetary policy differently. Monetarists see the role as not as fixing problems, but as refraining from causing them, having a stable policy that allows the private sector to flourish. Where we differ from monetarists, I would say, are 2 points. Milton Friedman favored targeting growth in the money supply at a steady rate of, say, 4% a year or something like that. And just leave it at that. Just have the Fed, have the money supply grow at 4% a year. Because the velocity of circulation can be unstable, market monetarists prefer targeting nominal GDP growth. Now, if velocity were constant, those would be the same, because money times velocity equals nominal GDP. So if velocity never changed, targeting money supply growth would be like targeting nominal GDP. But if velocity goes down, we favor increasing the money supply to offset that, and vice versa. So that's one difference. We favor targeting nominal GDP rather than the money supply. And the second difference is we favor relying on market forecasts rather than just a steady rate of growth in the money supply. So in our view, the market it's not perfect, but it's the least bad forecast of where we're going. In other words, let's make it simple and use the current Fed target of 2% inflation. Simple example, if the Fed wants 2% inflation, they should set policy at a position where the market is forecasting 2% inflation. It's that simple. It's like a captain steering a ship across the ocean. If the goal is to reach New York, the steering wheel should be set in a position where you forecast you will land in New York, taking into account all the kinds of wind and currents and everything buffeting the ship. So the Fed should set its interest rate or its money supply at a position where the market believes they will achieve their target, whether that be 2% inflation or 4% nominal GDP growth or whatever target they choose. The market signals are going to be the most reliable.
Okay, so let me digress, and since we tackled the monetarist school, what about the new Keynesian school? The economists in that school modified their models to include some things they learned from monetarism and the rational expectation school. But still, what are they missing?
Well, I think my primary difference with the new Keynesians is really just on a few points. So I do think they overestimate how much the private economy is unstable and needs to be fixed with, active monetary policy. I think they still rely a little bit too much on interest rates as an indicator of the stance of policy. So I think some new Keynesians in 2008 misjudged what the Fed was doing wrong because they were lulled into complacency by the fact that interest rates were only 2%. And I don't think they rely enough on market forecasts, market indicators to guide policy. They rely too much on sort of, computer models of the economy where they plug in all these numbers and the model spits out what the policy settings should be. But those models tend to not be very reliable because the macroeconomy is always changing, always facing new challenges. Just think about COVID. I mean, none of our models really had addressed anything like COVID. So you really need to look at market indicators. And I could give you even a pre-COVID example that I think is very interesting. Just a year before COVID, 2019, the Fed went into the year expecting no rate cuts. And using a new Keynesian model, they probably would not have cut rates. But in fact, the economy was buffeted by a trade war with China early in the year. Stocks fell sharply. Investment was threatened. So the Fed cut rates 3 times in 2019, reacting to market signals, not based on their computer model of the economy. And it turned out those market signals were correct. The Fed's 3 rate cuts stabilized the situation. By late 2019, things had stabilized and were growing again. And probably if not for COVID, we would have had a pretty good year in 2020 because the Fed had increasingly been relying on market signals, not on their computer models.
You build your case for market monetarism on rational, or what you call consistent expectations, and the efficient market hypothesis. Why? Why do you have such confidence in those 2 schools that you borrow from?
Well, here again, I'm kind of a contrarian because a lot of people believe markets are not efficient, that there's a lot of, bubbles in asset prices and so on. And as you know, in the book, I spend a lot of time pushing back on that theory. And one of the things that's kind of gratifying to me is that I've been pushing back for a decade on this theory. And recent events, I think, have tended to strengthen my hand a little bit. Let me give you 2 quick examples. After the tech bubble burst in 2000, almost everybody agreed that the tech sector had been overvalued in the stock market when it fell sharply in 2001 and 2. But now that it's come back to a level many times higher than 2000, and a lot of these little tech firms have grown into giants that are highly profitable, it's no longer clear that the market was irrational in being optimistic about tech stocks in 2000. Second example is in 2006, we had high housing prices and then they slumped. Again, everyone said, oh, that was an irrational bubble. There was never any justification for those high housing prices. But of course, recently they've come back up to very high levels. And there's a deeper understanding that there really are fundamentals in the 21st century underpinning high housing prices, 2 of which are the NIMBY phenomena of not in my backyard. It's harder and harder to build in many cities. That pushes prices up. And also the permanently low real interest rates we're seeing in the 21st century. Those low interest rates make any given flow of dividends, interest, rents, or any kind of income flow more valuable because they're discounted at a lower real interest rate. So we are now discovering retrospectively that all those claims that the tech bubble of 2000 and the housing bubble of 2006 were obviously overvalued are no longer anywhere near as clear as we thought at the time. And you've seen numerous other false bubble predictions for everything from Bitcoin to, many different assets where people are too quick to judge something a bubble. So the efficient market hypothesis to me is a very powerful hypothesis because if it were truly false, it should actually be pretty easy to get rich, right? If the market's clearly efficient and you can see that in real time, overvalued or undervalued, then you just consistently invest in undervalued assets and sell short overvalued stocks. And you do this, and in the long run, you should make a lot more money than just investing in an index stock fund.
Right.
However, studies show that people that invest in index stock funds on average do better than those that try to time the market. Not every time, of course. There's some individuals that are successful and make correct predictions, but on the whole, I think the market forecast is the least bad forecast we have, the most reliable, rather than trying to second guess the market. So yeah, I'm a believer in the efficient market hypothesis. Rational expectations were proved very valuable in the 60s, 70s, 80s when Phillips curve models, which predicted that high inflation should result in low unemployment, didn't pan out in the long run because people got used to the high inflation. They factored it into their wage decisions, their interest rate decisions. And so the inflation stopped having the expansionary effect that the Keynesian models predicted. So I think if you base your models on the idea that the public is going to consistently be wrong, your model isn't going to hold up in the long run. There's just too much money at stake, and people have a strong incentive to figure things out.
One of the concepts in the book that was really over my head, but it's just a great phrase, is what do you mean by one derivative beyond Hume?
Yeah, so David Hume worked out the basic idea of the quantity theory of money, which is that, higher money supply means higher prices, and a falling money supply means falling prices. And he even worked out the business cycle aspects. So, if prices go up, there's often a boom in the economy. If they go down, there's often a recession. Now, this was under sort of a gold standard type system or silver standard back in the old day. In those days, the long run trend rate of inflation was roughly zero. So prices went up, they went down, but there was no trend rate of inflation. And so what he was looking at, every time he saw inflation, he was seeing unanticipated inflation. And every time he saw deflation, he was seeing unanticipated deflation. What Hume didn't know is if you made inflation permanent and people got used to it, it would no longer have the effect that it had when it was unanticipated. And this is what Milton Friedman figured out in the 1950s and 60s in his natural rate hypothesis. He figured out that if the inflation is persistent, the wage demands will catch up to that. Workers will expect higher inflation, demand higher wages. And so both wages and prices will go up in tandem, and eventually everything in real terms will go back to long run equilibrium. You won't have any long run Phillips curve trade-off between inflation and unemployment. Same thing with interest rates. Once inflation became permanent, they started affecting interest rates, the so-called Fisher effect, named after Irving Fisher. So persistently higher inflation leads to higher nominal interest rates. So what Friedman was really saying is that much of what we knew in macro, we already knew in the days of David Hume in 1750. But what we've learned since is a better understanding of not just what happens when the price level goes up, but what happens when the rate of inflation persistently rises. And that's where the Fisher effect, the natural rate hypothesis, these more modern models of the mid-20th century come into play.
One of the things that struck me in your book was that you bring up the gold standard, and the older macroeconomic models, including that of Keynes, really did rely on commodity money. What I got from reading that again is that it really tripped up later economists who were trying to borrow the work of earlier economists. Have I got that right?
Yeah, I think so. I mean, I wrote a paper on this a while back. If you look at Keynes's, famous book, The General Theory, I mean, there's 100 ways to interpret what he said because he was sometimes ambiguous in that book. But I mean, one of the things he emphasized was at very low interest rates, monetary policy may not be very effective. And if you think about it, let's say that weren't true. Let's say that Keynes believed that monetary policy could always create enough aggregate demand to have a healthy economy. Well, in that case, Keynes never would have recommended fiscal stimulus, right? I mean, why would you recommend fiscal stimulus if monetary policy alone can provide adequate level of aggregate demand? And I think the reason he was skeptical is he was living in kind of a gold standard framework where monetary policy was very limited in what it could do because money had to be backed with gold. So when you look at Keynes's writings closely, you never see him showing an awareness of what a positive trend rate of inflation would mean. He doesn't talk about the Fisher effect with interest rates, that easy money can make interest rates go up by creating inflation. He's no awareness of Milton Friedman's natural rate hypothesis, the idea that persistent inflation would lead to wage increases and then the effect of expansion would wear off. And if he really was worried about liquidity traps, there's a very easy solution. Just have the central bank target the inflation rate as a high enough number so interest rates don't fall to zero. He didn't recommend that either. So he was implicitly working with an environment where long run inflation is roughly zero and you have rising prices and falling prices. And he was still working in David Hume's world, even almost 200 years later, because whenever you're on a commodity money system, even though you do have temporary periods of inflation and deflation, the long run trend is roughly zero inflation. And so people don't really expect inflation in the long run, and they don't factor that into their economic decisions.
We're about a half hour in, and I've pretty much monopolized all the questions. I have a few more, but I think I'm going to ask my colleagues to interject with a couple of questions. It's been a fascinating, illuminating discussion so far. So I'm going to ask David to chime in. Unmute yourself, of course.
Yes, I thought a lot about your central argument, and I was reminded of Stephen Hankey's proverb that it's the money supply stupid. And that sort of resonates with my training at Virginia back in the 60s when we were deeply invested in Milton Friedman's monetary theory. And I was taught to believe, and I think correctly, that it's all about the money supply. Now, I understand that you could have monetary expansion, but no stimulus because of a countervailing fall in velocity, which I think is what happened the last couple of recessions. But there could be a problem too targeting nominal income, because you could have your eye on nominal income, but real income could be changing in a way that is countervailing to the goal of whatever your target is. Is that an issue? I mean, especially in considering the state of the real economy these days?
So, yeah, I mean, it could be an issue. So a couple of points here. George Selgin has a book called Less Than Zero, which makes a very strong argument for nominal GDP type targeting over inflation targeting. So, I mean, the standard argument against nominal GDP targeting is what you said, like if real growth falls, you could end up with higher inflation than you'd like. But what both George Selgin and myself agree on is that the things that we worry about inflation for actually in some respects apply better to nominal GDP growth. And some of those are like redistribution between debtors and lenders. I mean, that can occur with unexpected inflation, but it can also occur in maybe even more pronounced way with unexpected movements in nominal GDP. Also, when you think of like how deflation could cause unemployment, a better indicator would be falling nominal GDP. Like deflation does not cause unemployment if nominal GDP is rising rapidly. This happened, for instance, in China, where they had rapid real GDP growth. So they had mild deflation, but nominal GDP growth was still very strong. And the reason we focus so much on nominal GDP rather than inflation as being the variable that really matters for our welfare is two factors. First, nominal GDP is the revenue with which businesses have to pay wages, and nominal wages are sticky. So when nominal GDP falls, you tend to get a lot of unemployment because there's less revenue earned by business to pay workers' wages. Second, nominal debts. Most debt contracts are nominal. They're not indexed to inflation. And nominal GDP is the total revenue source, this total pie, if you will, that is available to repay all those nominal debts. So when nominal GDP falls, you're likely to have a debt crisis because there's simply less total income in the economy in nominal terms to repay all the debts. And historically, whether it be the Great Recession or the Great Depression or Europe, as we saw in 2008, 9, 10, 11, debt crises occur when there's a big fall in nominal GDP. And so it is true what you say, that if you target nominal GDP, you are allowing inflation to move around and vary from the 2% target path in the short run. But in the long run, if you target nominal GDP growth at about 4% a year, you'll probably get about 2% inflation on average. It will vary year to year inversely with movements in real GDP, but those movements actually may be stabilizing for the economy. You might want to allow a little bit more inflation when aggregate supply is depressed, and you might want less than 2% inflation when there's strong productivity growth boosting aggregate supply. And so we feel that nominal GDP growth is actually a more stabilizing factor to keep constant rather than in the inflation rate. Although we also believe that doing this will give you roughly the desired inflation rate in the long run. It's just there'll be ups and downs along the way.
Well, Frank, do I get one more shot here?
Sure, go ahead.
Oh, yeah, I'm interested in the forthcoming CBO scoring of the what I would call the monstrosity spending program by Biden. And I'm also find it fascinating that 17 Nobel laureates signed off on that program, favoring it. Do you have any thoughts about the about another $1 or $2 trillion or more, depending on how you time it? How the effect of that on inflation and on the economy?
Well, first of all, I'm not really in favor of fiscal stimulus. I believe monetary policy is a much more effective tool for, providing the right level of nominal spending in the economy. I don't think fiscal stimulus is as effective as Keynesians believe. In terms of the effect on inflation, it's a little hard to predict because it depends to some extent on what the Fed does. So the Fed is supposed to have a long run 2% inflation target. Now, right now, there's a little bit of questioning because inflation's been above target, and some people are doubting the Fed's commitment to do so. But they certainly have the tools, if they're committed, to bring inflation down to 2% over the next year or two, whatever. Even with fiscal stimulus, there's no limit to how much you can tighten monetary policy. You can raise interest rates as high as you wish. It's more a political question, but having said that, so I'm not certain how much inflation will come out of this. My opposition to fiscal stimulus is not so much founded on the notion that it'll be highly inflationary, although it might be if the Fed doesn't appropriately, offset that with tighter money. My opposition is that it's not going to help the economy much, but it will create future challenges by making the national debt larger, which will require future tax increases, which will slow economic growth. So I feel like fiscal stimulus is a wasteful way to expand the economy. Now, that doesn't mean every single thing they do is wrong. There may be some items in the package that on a cost benefit basis are justified. I'll put that aside. But if we're doing spending with the goal of just stimulating the economy, I don't think that's a wise use of fiscal resources. We should have monetary policy, create the appropriate level of aggregate demand, and only do fiscal spending when there's a clear cost benefit advantage.
Okay, I'm going to defer to Will Burke at this point, who may have questions of his own and has been keeping track of questions from our other viewers. Will, you want to jump in?
Yeah, no problem. I will. I'll first go to the audience's questions. The first one: can you elaborate how a 0% interest rate forestalls inflation?
All right, so yeah, good question. So a 0% interest rate sounds expansionary because it's a low rate. But if we're talking about 0% as kind of the equilibrium interest rate in the economy, we're really describing a weak economy where there's not much investment demand, and that's why interest rates are low. So you could sort of say people are sitting on their money, they're saving money, but there's no investors wanting to borrow it, putting downward pressure on interest rates. For whatever reason, if interest rates are at zero, then newly created money is no longer sort of a hot potato that gets spent. Let's go back before the Great Recession, when say interest rates were 5%. If the Fed puts money into the economy, which at that time didn't earn any interest at all, bank reserves and cash. People don't want to just sit on zero interest rate money when they could earn 5% on a treasury bond. So they would quickly spend it, and that creates inflation. But if the treasury bills are also yielding 0%, then essentially money is just as good an investment as a T-bill, and people are willing to hold that as a liquid asset because of a lack of better opportunities. So, you know, sure, you can invest in stocks and so on, but if you're talking about safe assets, other safe assets were also yielding zero interest. And inflation is all about the relationship between money supply and money demand. So as David pointed out, traditionally we think of an increase in the money supply as inflationary. And I was brought up believing that, and that is usually true. But if the money supply is increased during a period where money demand is also increasing, the willingness to hold money as an asset, then it doesn't necessarily have the inflationary impact. Inflation occurs when the money supply is increased at a time when the public does not desire to hold more money. You're just forcing it in the economy, and it ends up pushing up prices. But if it is meeting the demand for liquidity where the public is afraid of investing or whatever and just wants to hold a safe liquid asset, meeting that demand for a liquid asset with an increase in supply, according to the QE programs, basically, is not necessarily inflationary, or at least doesn't have a large inflationary effect.
Next question. Whose estimate of inflation do you consider indicative of the actual inflation rate? The government's? Well,
There is no actual inflation rate because the term inflation is ambiguous. Like, what do we mean by inflation? Like, if we had an economy where everything was simple, like gallons of gasoline or, you know, gallons of milk or whatever, you could measure inflation fairly easily. But we have an economy where things are changing very rapidly over time. A TV set today is nothing like one in the past. An iPhone, I mean, how do you compare that to a telephone in the past? An iPhone does a thing of 20 different items in the past. So if we're trying to measure the so-called cost of living, it's always going to be a judgment call. All right. So that's my first point. There's no perfect estimate of inflation. My second point is be very, very skeptical of some of the things you see on the internet of truth claims about inflation actually being way, way higher than government estimates. So I've been seeing these articles for many years, and they're not really very plausible, because if some of the numbers they're citing were true, then that would mean the economy's basically been in a deep depression for years. I'm not talking about COVID, I'm talking about 2017, 18, 19, when the economy was booming. If some of these contrarians about inflation were correct, and it was really, you know, 6, 8% a year, that would mean that real GDP would have to be falling, and we should have been in a huge depression. But none of the other indicators in the economy were indicating that, right? I mean, unemployment was low, the stock market was booming, like there was nothing indicating the US economy was in a deep depression. Right. But that's what we would have had to been in if it were really true that inflation was running 6 or 8% a year. So if anyone out there has read some contrarian takes that claim inflation is actually much, much higher than believed, be skeptical. But the idea of there being a true inflation rate, will never have it, because all these quality changes are judgment calls. There's no perfect way to measure how much better a computer, an iPhone, a television is than an older one. It's based on this notion of utility in economics, which can't be, we'd have to be able to scan people's brains and figure out how much happiness they get out of different products, and that can't be done. So because we don't live in a simple commodity world where you can just add up loaves of bread and gallons of gasoline and stuff, we don't really have any way to get a perfect measure of inflation. And I don't have any problem with the government estimates as giving us a rough indicator. I mean, clearly the recent figure of 6.2 is way above what it was in recent years, where it's running around 2%. And I think almost everybody in the public would agree that in the last year, inflation's been considerably higher. Now, maybe the 6.2 isn't right, you know, could be 5.2, 8.2, something like that. But I do think the government figures do correctly show swings up and down in the inflation rate that are, relatively useful.
Okay. Does it make sense to add maintenance of full employment to the Fed's portfolio plate?
Well, that's a good question. So Congress gave the Fed this mandate of stable prices and full employment. It's kind of a vague mandate, but over time, I've come to kind of agree with it in this sense. Like, I don't think the Fed should actually be targeting the unemployment rate or employment rate. But I think what Congress is really doing is saying, like, look, we don't know exactly what you should be doing. We're not like professional economists, but these are things that we think are important. Like, we'd like there to be relatively stable prices and high employment. We think a good economy exhibits these traits. So what you need to do is come up with a policy that you think will achieve these things, and then report to us on why you're doing things and what sort of success you're having, okay? And I think if you look at it that way, it allows the Fed to say, well, we think, a 2% inflation target actually best balances these two goals. And, you can disagree with that. Some people think it should be a 0% inflation target, but at least the Fed can go to Congress and say, well, we made it 2% because, yeah, that's a little more inflation than 0, but we think that helps us a little bit on the employment front. And it helps us a little bit avoiding liquidity traps where the interest rate is stuck at 0, because with a little bit higher inflation, it feeds into a little bit higher nominal interest rates and so on. So my personal view is that nominal GDP growth addresses both sides of that equation. So nominal GDP growth is real GDP growth plus inflation. Obviously, the inflation, is related to the congressional mandate, but real GDP growth is closely related to employment. So by targeting nominal GDP, in a sense, you're balancing these two goals of high employment and inflation in a roughly equal way in a single target. And I think monetary policy is more effective if the Fed focuses on just doing one thing, like steady growth in nominal GDP, rather than trying to figure out, well, like, what's the appropriate unemployment rate, what's the appropriate inflation rate, and all this. We don't even know what the natural rate of unemployment is. So if you think of Congress as just giving a broad set of goals, I think it's a reasonable mandate. If you think in terms of should the Fed be targeting employment directly, I'd say no, because they don't know how much employment we can have. A lot of people think that recently the labor force has dropped permanently because of, retirements or less immigration or whatever. And we seem to have a shortfall of several million workers that we don't know where they are. And that just shows you how hard it is. If the Fed were to try to target employment, they could easily misjudge the situation and end up way off course.
Okay. Do you feel the Fed chair is doing a good job of remaining aloof from political pressures? And do you believe the POTUS will reappoint Powell?
There's a contemporary question.
Oh, yeah. The reappointment, I don't know any more than anyone else.
Right.
So, I think probably I would lean towards the view he should, just to let Powell continue with what he's been trying to do, which is this average inflation targeting policy. I think Powell has done a pretty good job of remaining above the fray, but it's easier to do that in certain times than others. And now that you could argue that we probably should have a little bit more contractionary monetary policy, I don't know, if someone said, well, maybe Powell is being too much trying to please Biden right now, I don't know. I'm not in a position to judge, but that's possible at least. Like, everybody, I think, expects a decision to be made soon, right? On Biden on Powell or whatever. And I think it's human nature that Powell probably didn't want to do an unpleasant, unpopular policy adjustment right before Biden was making that decision. And if he had tightened monetary policy in the last month or two, that might have, been unpopular and led to him not being reappointed. So this is all speculation on my part. I think Powell's done a pretty good job overall. I think in recent months, maybe policies drifted too much in an expansionary direction. And whether that's due to politics, I can't say.
Okay. I have a question. Well, I just want to see your thoughts on the matter, but could you provide any context or thoughts on negative interest rates?
Yeah, so I think there's two important distinctions here. One is, do you want a policy regime where you end up in a negative interest rate environment? And the other is, should the Fed be allowed to pay negative interest rate on bank reserves as a tool? And I give different answers to those questions. So I think you want to avoid a world where your country has negative interest rates. Like, I think that's usually a bad outcome. And I think there's ways of avoiding that world. If you end up in that world, what?
Do you mean nominal or real negative?
Nominal.
Okay, nominal.
Negative nominal. Like
do you
they have in Europe and Japan, I believe. So they have negative nominal interest rate. Literally, you don't earn any interest rate. In fact, you have to pay the other way when you deposit money or you buy a bond in Europe, right? So for various reasons, I don't think that's a desirable outcome. And the only way I think to avoid that is to make sure that monetary policy is at least expansionary enough to have nominal GDP high enough to avoid negative equilibrium interest rates. But, and this is important, however, if you do find yourself in that world, the central bank may want to pay negative interest rates on bank reserves as a tool to get out of that world. Because if you're in a negative interest rate world where the equilibrium rate is 0, and you don't let your central bank cut rates to a negative level on its policy instrument, monetary policy becomes tighter and you get permanently enmeshed into this world. It's like you're stuck in quicksand. You can't get out of it. Ironically, when you move interest rates one way in the short run, they usually go the opposite way in the long run. So, you know, in the Great Recession, the European Central Bank raised interest rates several times. They thought the Fed's low interest rate policy was foolish. Said, you know, that's terrible. Look at the Fed has near 0 interest rates. So they raised rates. But because they did that, they pushed Europe into a double dip recession. And then interest rates in Europe went way lower than the United States. So by the end of the 2010s, the US again had positive interest rates, but by then Europe had gone into negative rates. So because the short and long run effect of policy on interest rates is different, you have to be very careful in making judgments about things like negative interest rates. Like if you want a higher interest rate world, the way to get there might be to cut interest rates in the short run, stimulate spending, growth, a little more inflation, more nominal GDP growth, which will lead the equilibrium rate to be higher in the long run. Conversely, if you have a tight money policy, you raise interest rates like the European Central Bank did in the early 2010s, you push them into recession, and then interest rates fall even to negative rates as they have in Europe. So there's no easy answer on the negative interest rate question. But again, you want to stay out of the world where you're stuck in permanently negative interest rates, but you don't necessarily get out of that world by raising interest rates in the short run. You may just push the economy deeper into a slump. So I wish I could give you a simpler answer, but that's what's involved there.
Thank you for that. One last, I believe it's a statement on bubbles. If you could comment on this. Have you seen the levels at which the VCPE community have been slamming money into startups while interest rates were sitting at rock bottom? They sure aren't holding on to their money. They are putting it out as quickly as they can, generating the mother of all unicorn bubbles.
Okay, good point. So the term money is used in many different contexts, and it can be true. And this is something that surprised economists, let me be honest, including myself, the extent to which one sector of the economy can be very frothy and fast growing and, you know, dynamic, like high tech, with lots of money pouring into high tech firms. And at the same time, large amounts of people's wealth are just put into 0 interest rate assets, treasury bills, bank deposits, things like that. Both of these can be occurring at the same time. I think that's because the world of capital, if you will, is segmented. There's some people that want safety, and there's a lot of people and institutions and banks, insurance companies, pensions, whatever, that will invest in bonds that have very low yields. At the same time, other people are going into high-tech companies that offer possibly great returns, but with high risk, right? So it seems like what I said about there being a lot of demand for money sitting in a low interest rate environment doesn't make sense when you look at those high-tech investments, but that's only one part of this huge capital structure we have, right? And there's still a big amount of wealth out there that people do want to park in safe assets and are willing to have sit in highly liquid forms of money without creating a lot of inflation. Now, maybe now we're finally getting some of this inflation, and we'll have to see how this plays out. But certainly over the previous decade, there was a lot of money creation without much inflation. And I think that's because the demand for safe assets was very high, even as other investors were going into these speculative and rewarding sectors like high tech.
So do we have time for one more question, Will?
You have about 4 minutes to the end of the hour.
Okay, so let me go back to your book, and one of the things that you point out is that you write the increasing spread and growing sophistication of financial markets would inevitably lead to the creation of an NGDP futures market. Technological changes such as big data will eventually lead to real-time estimates of NGDP at a monthly and perhaps a daily frequency. You seem to place a lot of faith in the market. Would a central banker buy into that?
Well, it's going to be a challenge to convince central bankers, but let me be clear. They've already bought into it to some extent. Like central bankers, and they admit this, they do look at market indicators. If you look at the minutes from a Fed meeting, they'll talk about things like tip spreads. Well, what is the tip spread? It's a market forecast of inflation. It's the difference between the interest rate on a regular nominal bond and a real interest rate on an index bond. So if you just look at the tip spread, you can go online and look at this. You can see directly the rate of inflation being forecast by the market. And the Fed minutes tell us that they already are looking at some market indicators. Whether they will be willing to go as far as I would like, that's a real challenge because policymakers like to have control of things. They don't like to turn it over to the market.
So
but I do think that we are moving into a world where there'll be better and better market indicators coming along. And this will gradually have an impact on policy. I think market indicators will be increasingly important in directing policy in future decades. I do see that as the trend or where things are going, but we're a long way from what I'd like to see.
let me finish with one thing I read in doing the research for this interview is, I think he's your colleague, Arnold Kling, who seems to write the same blogs you do. I made an interesting criticism of market monetarism, saying that it lacks a really good algorithm. How do you respond to that?
Well, yeah, I mean, we're not trying to do the same thing that traditional, macro models are trying to do. So we're not trying to develop a model, a computer model that will, tell us what the stance of policy should be, where the interest rate setting should be. So we favor an approach where you basically have the market directing policy, guiding policy, if you will. And that's just hard for people to get used to. I mean, it's very different from the way most economists think about policy. And so, I mean, I think that's what he's referring to there. We're not operating in the way the traditional model does. And so, we haven't made a lot of headway with, mainstream economists at elite universities in convincing them that this approach is best. But we have had quite a bit of success in certain areas, like nominal GDP targeting is much more talked about now than when David Beckworth and I started talking about it in 2009. The Fed's average inflation targeting policy adopted in 2020 is not exactly what we were proposing, but it's similar to the level targeting idea that we suggested, which is that when you go away from the trend line, you commit to come back to the previous trend line for prices or nominal GDP. So we are seeing policy changes in limited areas that are moving in a market monetarist direction, but it's a real challenge to get policy to adopt market. Now, I've advocated the guidepost approach. I don't know if I have time to get into that, where the Fed still would have discretion, but there would be a futures market a little bit above or below their target, where they would have to take bets on futures contracts against people that thought their policy was going to fail in a big way. And this would be sort of like guardrails on a highway. It would keep policy from going too far off course. So under my proposal, like in late 2008, when nominal GDP was clearly going to fall sharply, the Fed would have had to take a long position on NGDP futures contracts, and it would have been afraid of losing money, so it would have had to make a much more expansionary monetary policy. So I have a Mercatus paper, I think, that discusses the guardrails approach. But anyway, there are some sort of hybrid approaches where you bring market forecasts into the picture, but don't take the Fed discretion completely out of the picture, because I don't think they're really comfortable yet with turning it over 100% to the market.
Unfortunately, we're up against a hard break. I
Okay.
want to thank Scott again for this great presentation from which we all learned a great deal. Thank the members of our audience. And also, of course, Frank Conte for organizing the whole thing. We'll be posting this on our website so you can go back and revisit it. And I think that will be necessary for a lot of us so that we can mull over some of the sophisticated points that were made in the course of Scott's presentation. So thank you again, and we'll let you know about the next webinar when it comes along.
Thank you.
Thanks,
Thank you.
Scott.
Right.